Financial stock under pressure today. Let's get more from Bloomberg's Stephanie Hughes. Stephanie, thanks so much for joining us. Why was SLF down?
Hey, Andy. Yes, so Sun Life Financial fell as much as 10% today, and that was its biggest intraday decline since the onset of the pandemic in March 2020. And that was because its underlying earnings of about $1.68 per share really just fell short of what analysts were expecting. And a lot of that had to do with the U.S. segment. So this was a business, the U.S. segment, that saw stronger momentum earlier in 2024, but that momentum fizzled out at the end of last year because of a bounce in what they call morbidity claims in this stop loss segment there. In other words, more clients were falling ill and passing away, which fueled a jump in claims. CEO Kevin Strain explained to me that some of this was due to people avoiding hospitals during the pandemic and weren't going in for regular checkups. So that led to worse health outcomes, unfortunately. So the U.S. earnings segment fell by about 39% year over year. And even though it's a tough day for the stock by Kevin Strain's own admission there, he told me he's optimistic about building out the four pillars of his business, which includes Canada, US, Asia, and the asset management segment. TD Cowen said that there's a lot not to like in this quarter, but a few other analysts, I should say, were browbeating their earnings here. But I will say that National Bank's Gabriel Dechaine was somebody of an outlier here, expecting that the margins will eventually rebound and that a big pullback in the shares here could even be a buying opportunity there, Andy.
And morbidity, I love that word that the life insurance people use. Yeah, Canadian Tire, apparently automotive did well in the latest period, but gardening was a weak spot.
Yeah, it's just retail softness, even though there's consumer sentiment that's been rising, so says the CEO. But that stock fell by nearly 7% or around 7%. That was the biggest drop since last August, and it was another TSX decliner. A lot of this was driven by softer same-store sales in the retail segment and underperformance in the CT financial services, i.e. the credit card with the cashback that it offers. In the press release, CEO Greg Hicks said the team charted strong earnings and a return to growth, pointing to some economic green shoots like improving consumer sentiment and spending. However, on the conference call, he did flag that concern around tariffs as this looming threat, right, that could even erase some of this improving sentiment there. But he added that management is working on ways to keep the full brunt of potential tariffs from tariff costs, I should say, from hitting the shelves by reviewing products in U.S. suppliers and seeing if they can find alternatives. So Canadian Tire is one of those interesting companies that serves as an economic bellwether, especially with the credit card segment there. The default rate in Canadian Tire credit cards also hit 7%, which was the highest since about 2012. Scotiabank analyst said that the results are negative, and he expects that there's going to be a market reaction that's negative as well. And you're seeing that with the share price today, Andy.
Looks like I'll be heading there for some dog-friendly assault for my bit of sidewalk soon. Thanks very much, Stephanie. Stephanie Hughes of Bloomberg.